My name is Jeff Barclay, and I'm a co-chair of the conference. Delighted to see you all here. And it's my pleasure to introduce our next speaker, Sharmin Mossavar-Rahmani. Sharmin is a colleague of mine at Goldman Sachs, and I'm very proud to know her and have gotten to know her quite well. She is the Chief Investment Officer of the Private Wealth Management Group in the Investment Management Division of Goldman Sachs. In that role, she is responsible for leading a team that analyzes and presents and thinks through all the major ideas that have been in the background of what we've been discussing here today, and importantly, to recommend strategies for investment for Goldman's private wealth clients. Sharmin is a published author. She's a graduate of both Princeton and Stanford, and most importantly, she is a devoted dog lover. Her remarks today will reflect some observations on the global economy and hopefully some implications for investing across a variety of asset classes, not necessarily just real estate. With that, Sharmin.
Thank you, Jeff, and good morning, everyone. As Jeff mentioned, the purpose of this session will be to share our outlook on various parts of the global economy and the financial markets. Obviously, with what's going on in Europe, the key areas of focus are going to be the US, Europe, and China, with all the discussions of a hard landing. I'll try to keep my comments to about 20 minutes and leave about 10 minutes for Q&A. There's some interesting materials. If anybody'd like a copy, please let me know later on, and we'll make sure you get one. Actually, let Jeff know, since you probably know Jeff better than you know me. In terms of the issues that are out there, as you well know, one big question is, in the U.S., risks of a double-dip recession. So the thought about global growth slowing down and of so many economists revising down their economic forecasts, the World Bank, the IMF, and the numbers range globally between 3.5% and 4.5%. More and more numbers are coming out closer to 3.5%. So the worry is, will the U.S. in that environment be facing a double-dip recession? In Europe, the key question is obviously the sovereign debt crisis, for a while contained to the peripheral countries, but now not just Italy, but even, as you well know, France. And French spreads have widened, and people are quite concerned. A couple of people out there are even talking about default for either Italy or Spain, which we think is a bit of a stretch, but still that's the sentiment in the marketplace. And with China, the question is really, are we going to have a hard landing or a soft landing, especially with a tightening of monetary policy? So the comments will focus on these three areas. What's interesting is if you look at actually the returns in the market, and you can see U.S. total return, looking at the S&P 500, basically about flat. Europe down about 11+%, and China even a little bit more. So the market obviously has given a sense that the risks in emerging markets, and in China specifically, are greater. The market was probably more overvalued relative to the other markets. European concerns, but Europe has been sort of suffering for a couple of years. And in the US, interestingly enough, because of the phenomenal earnings growth that we have had over the course of the year, and the run rate for S&P companies now at just over $100 per share, which is pretty remarkable, is a pretty significant statement in our view that the market's basically flat given all the risks and all the concerns. So let's focus on the US. Why are people so worried about a double dip? And the key theme here is that when we're looking at past recoveries in the post-war period, we've generally grown somewhere between 10 to 14% cumulatively in terms of GDP from the trough of the crisis. Now we're at 5.6%. So the question is, are we going to have a lost decade? Are we going to have subpar growth? Are we going to face the same issues that Japan faced, where it lasted a long time? So that's one of the big concerns. And for those who might have read about or actually read the book from Carmen Reinhardt and Ken Rogoff saying this time is different, there's a lot of concerns because they talked about a 10-year period. What's interesting is in early 2009, they published another article. And in that article, they provided a lot of data and examined various countries. And what we noticed is that what you see in the major developed countries, so leaving emerging market countries aside, is that the first 5 years after a financial crisis, you do have significant subpar growth, or in the case of, let's say, Finland in this exhibit, even marginally negative growth. But in the second 5 years, the growth actually recovers to the levels before the crisis. So as people worry about the implications after a financial crisis and the deleveraging that has to go on, and the previous panel spoke about that a little bit, about sort of the deleveraging and does that have to continue among financial institutions, the thought was 10 years. Household deleveraging, financial institutions deleveraging. But what this shows is actually that's not necessarily the case. Even with past financial crises, actually, it looks like if we were to look at the ranges, typically the recovery to pre-crisis levels happens between 3 and 5 years. So even if we wanted to use 5 years, you're looking at US recovering to a 3% type GDP by sometime in 2012. That is not our central case. We're actually going to go through that. But we thought it's important as people become very pessimistic and think about a lost decade. We have not had that view since the inception of this crisis, and we think the data actually points to that. What you see on this page, and I realize you may not all be able to see all the detailed numbers, the key point is there's more green than there's red. And what green is pointing to is the trend of these various economic indicators. Some are leading economic indicators, some are coincident. There's a set on the housing sector that you can see, industrial production numbers that came out that were pretty positive, claims. And a couple of these numbers were just released this morning, so the claims today actually is even lower than the claims we have up here, because this was the one from last week. So a couple of numbers released today were also on the positive side. So as we look towards the general trend from the US economic perspective, we think there's more good news in aggregate, especially with the leading indicators, than there is bad news. And what does that translate into in terms of our views? We generally work with our clients in terms of probabilities and never have point estimates, because we think that sort of gives a sense of sort of false confidence. Who can exactly pinpoint the S&P targets, growth targets, especially with all the revisions that occur? But what you can see from this exhibit is that our central case with a 50% probability is the US grows around 1.5 to 2. That's a little bit below consensus. There are many more numbers out there that are higher. Consensus is around 2.2%. But what you may note is two other things. One is we actually have a probability that there could be some surprises to the upside, and I'll go over those shortly. And our expectation of a sort of a recession and growth below 1.5 is 35%. Now, a question you might ask is, why didn't we split that into two sections? Sort of what's the probability of growth below 1.5, and what is the probability of an outright recession? And that might bring to mind the concept of stall speed that some of you might have read about. It's interesting. We've read all the academic papers. We've looked back at all the data. And the concept of stall speed in and of itself isn't that meaningful, in that it's not like the US economy is an airplane and has to be flying at a certain speed, that if it's flying at 1%, it necessarily means that 1% has to translate into a recession then. What you actually notice is that when you are growing at 1% or below 1%, the vulnerability to shocks are very significant, whether it's a geopolitical shock that could create a crisis of confidence, whether it's an oil price shock, whether it's a weather shock like the earthquake in Japan and the floods in Thailand, that the capacity of the economy to absorb those shocks is limited. And once you have a shock and you're growing at 0.5% or 1%, then you do fall into a recession. And so the stall speed concept isn't that once you're at 1, it has to go to a recession. It's that once you're at 1, you're more vulnerable to shocks, and shocks happen. So our view is that subpar growth below 1.5, for example, doesn't necessarily mean a recession, but our overall probability of risk to the downside right now is 35. But we also have a probability to the upside, and in our view, the sources of some upside come from two areas. One is business investment. So if you look at from your perspective, the right-hand side exhibit, what we're showing is business investment as a percent of GDP, and you can see how low it is. On the other hand, you can also think about profits and how strong profits have been, not just profit margins, but just absolute level of profitability. and earnings in companies. So this number, if you compared it to level of earnings and profits, is even more stark. So as we look at that and we think about the 2 trillion estimate of cash on balance sheets of S&P 500 companies, even if some of that is overseas, our view is that that has to get spent. With interest rates so low, they just can't leave it in short-term fixed income assets in the treasury departments of these companies. So either they're going to pay out dividends, or they're going to do buybacks, which will be good for equity markets, and that will boost confidence, and that'll be good for the economy, or they'll actually spend it in various forms of capital expenditures, and we think they'll probably do a bit of all. And the reason we don't think they're only going to do the first two is again, many of you are investors. Who actually likes to give money away, give capital away back to investors? What real estate fund ever early gives their capital? Oh, we can't find investment opportunities, we'll give the capital away. The same we think will be true of S&P 500 companies. They will say there are enough opportunities both within the US and globally for us to actually take advantage of them. So we think there could be some surprise on the capital expenditure side, especially with technology investment actually lagging quite significantly. The other exhibit that we put, and we tried to think of something a little bit more interesting than what you typically see because you're all such real estate experts, and that was an exhibit on housing that, in spite of the terrible experience that people have had in residential investments, homeowners, people still like the idea of owning a home and think having a home is a significant value-add investment. So what we're showing you here is looking at 1999 versus 2011 and surveying what percent think that owning a home is the best investment. And that number from 1991 to the present has actually gone up, which we thought is pretty remarkable. Our view is that it's going to take another 2 years or so to absorb the overhang on the residential real estate in terms of homes. So if you look at the overall inventory, you take out the typical average inventory that exists out there pre-07, pre-06, and think of an average inventory that we're going to have, what will it take to sort of take away the remaining, let's say, 3.5 million homes. So with housing starts, with general demolition needed to get rid of old homes that are falling apart, you look at household formation, adjusting for the fact that somebody talked about students and getting jobs, staying with their parents. You combine all of that, and our estimate is it's going to take about 2 years before we see this significant overhang being completely absorbed. So what about Europe? That's the big question, and one big issue is what about Europe and the contagion effect it could have on the US? You've been reading the headlines. What we're showing you here is spreads, and the spreads deteriorating across the board. And on the lower line, you can see France, which we think is a pretty significant change in the marketplace. And a big question out there is France going to implement enough reforms and aspire to be more like Germany, or will France follow the path of Italy? We've put a few timelines here. Some were on the positive side initially with the enhancement of the EFSF, the Financial Stability Facility, when all the governments approved it. But again, at the back of your minds, you want to keep the concept that, think about a country like Slovakia, 5 million people, just over 5 million people, holding this process up. So one of the issues with Europe is that we think of policy in 3 ways. It has continuously been incremental, it has been reactive, and it has been inconsistent. And it has been this way for nearly the last 2 years. So when we just look at the latest news, Merkel insists on private sector involvement in what happens with Greek debt, sovereign debt. The same token, the new head of the Bundesbank said that he thought private sector involvement is actually a very bad thing because it starts making everybody concerned about what happens to their Portuguese bonds, what happens to the Spanish bonds, and what will happen to Italian bonds. So they think that introduces the risk of contagion, but Merkel says absolutely not. We want the private sector to pay because Germans will not otherwise continue to support these various bailout measures. You saw that in the ECB when they said they'll never take Greek debt as collateral, but within a month they took Greek debt as collateral. They started raising interest rates in this environment. Mario Draghi comes on board and lowers interest rate. And our view is that that policy will continue. In some ways, we think they had their TARP moment. You remember when it was, I think, a Monday when Congress didn't approve the funding on a Monday, and at 1 o'clock you saw the market just crash, the S&P. In some ways, this Greek referendum idea that Papandreou put forth was that moment, in that suddenly things took on a very different atmosphere. The speed of deterioration increased, and even though we now have two technocratic governments in Italy and in Greece, it's not quite clear where those will be headed. Now, Italy has experience with technocratic governments. They had that in the early 90s, and they were very, very successful. So people are generally optimistic that they'll be able to get things done in Italy. Greece is still a very, very big question mark. And this is against the backdrop of a deteriorating economic environment. So obviously, if the economic environment was robust, Spain would have been able to meet its deficit targets. In fact, it's interesting that with modest growth, Italy was going to have a primary surplus this year and next year, 2011 and 2012, which is pretty significant, and they'd be on a path to reduce their overall debt to GDP. But with a weak economic environment and spread so high, the odds of them being able to achieve anything like that is pretty low. And so this weak economic backdrop that you're seeing across Europe is also making it much harder to implement austerity measures and meet any kind of fiscal deficits. So what are the alternative scenarios? We used this exhibit in a conference call we did with our clients in mid-August, and we had 3 scenarios, and we asked our guest speakers, and in fact, Mario Monti, who's now Prime Minister and sort of Finance Minister, Economic Minister in Italy, he was one of our guest speakers, and we asked them to give us probabilities of these scenarios: the good scenario, the bad, and the ugly. And most people were focused on the bad scenario with some chance of the ugly and very low chance of the good. The good is a scenario where you're going to see policy that's ahead of the markets. You're going to see much stronger statements out of Germany, better economic growth, spreads coming in. And obviously the odds of that in August, we said, were very low. The odds of that today are even lower. Our view is that we're going to vacillate between the bad and the ugly. So from an economic perspective, you can see we've said recession is in the ugly scenario. Our view of this consistent sort of pattern of European policymakers of being incremental, reactive, and inconsistent in their messaging will continue. There's no way that's going to change as much as, let's say, the US policymakers keep on sending various messages to the Europeans. It's just very hard, given the construct of the European Union, to see something that different. So then the key question becomes, what about a Greek default? Can it be orderly or disorderly? So let's say they get through the private sector participation and get to a 50% haircut. We know that's not enough. So the question becomes, will they have a deep restructuring, which is just a polite word for a default? And how will that be handled? What will the repercussions be for banks? And how will the market react for other countries? And depending on the market reaction and the sentiment, it could turn out to be quite disorderly and quite ugly and put pressures. And while we don't think the impact on the U.S. economy directly is that significant, the question is really one of sentiment and risk premium in the markets. U.S. is a relatively closed economy. It exports about, let's say, 10 to 12% of GDP is export-oriented, and of that number, about 3.5% is to Europe. So European exports Europe can have, and it's not a material impact on GDP. It's really the contagion from market sentiment, and to a lesser extent, to banks, but the problem is more sentiment on the banking sector than, in our view, the actual reality of major U.S. banks' exposure to Europe. So something in between the bad and the ugly. And what holds things together? At that same client call that we had in August, and we just had one last week with some very interesting speakers, everybody at the end of the day expects the ECB to be the glue that holds everything together. ECB does have significant capital. People have said their capital is about 80 billion, but actually when you look at the numbers, you look at the gains that they have, unrealized gains on their balance sheet from their gold and other assets that they have owned, it's about another 300 billion. And then if you look at what's called seniorage, meaning they print a piece of paper that's €1, but they actually can invest it and earn something on it, it's not an insignificant number. And so our view is that they do have the balance sheet. The question is at what point will they respond to the markets in a more meaningful way? Their history to date over the last 2 years is when they get pushed and European instability becomes very significant, the risks are high, they do react. But they wait till the very last minute, which means we're going to have a lot of volatility, spread widening, things look like they're going to unravel, and then the Europeans respond. And the reason we think this is going to be most likely scenario of the ECB's involvement is that they have no other choice. If they don't, and Europe completely unravels, that would hurt the Germans significantly. Why do the Germans like to be part of the euro? It's not just out of the goodness of their heart. Their banks have significant exposures to all of these countries. In addition, the same way China is very export-oriented, 45% of German GDP is exports. Of that, 70% is to Europe, broadly Europe. So it's a pretty significant number. So if all of Europe is unraveling, it's going to take a huge hit on Germany's economy. So our view is that they're going to be flexible when the pressure is very high and let the ECB do a little bit more. They did a little bit of bond buying yesterday, but they did very little, and it didn't have much impact in the marketplace. So the question is, when will they bring their equivalent of a sort of a Hank Paulson bazooka? And from all the people we speak to, the thought is the ECB is the only one who can actually have a bazooka, but it's going to take a little bit more market pressure before they actually show that. So what about China? We expect a soft landing in China. As you can see, our expectation for growth is 8 to 9%. They implemented a lot of significant measures to lower inflation because they thought inflation was a big concern for social stability in China, and at the end of the day, that's the #1 objective of the Communist Party, and they certainly have the financial wherewithal to adapt and adjust to the markets given their significant reserves, the amount of cash they have in the sovereign wealth fund, and the surplus that they continue to have. So they implemented some policy tightening measures. If they are to see that the economy is weakening too much, we think they will reverse those policy measures very easily. And they certainly, again, can do that. We don't think we're going to get a major housing real estate bust there. We have an exhibit to show you. In terms of prices, you've begun to see actually prices decline in some major cities. Construction continues. The demand for homes and apartment units is pretty significant. They have a project of 10 million units this year and 10 million units next year for low-income housing. We don't think they're going to get to that goal, but they can manage that. If private investment decreases substantially, they can increase the low-income housing construction efforts. So our central case is a soft landing, and we think that's very important. Again, more from a perspective of sentiment than a perspective of a weaker China having a huge drag on U.S. exports to China. Obviously, commodity prices will come down, and that actually could be quite good for the U.S. consumer. Gasoline prices at lower levels, food prices at lower levels, industrial metals at lower levels will all be very good, in fact. So we think a soft landing in China and generally lower commodity prices would actually be very good for our central case for the U.S. Now, what does that mean for equity markets? Our view is, and it has been our view for a while, in fact, we get called a lot by our clients, we're America boosters versus Europe and emerging markets. Our target for the S&P for this year and at the beginning of this year was 1,300 to 1,375. A couple of days ago, we thought we were pretty close to that target when the S&P was about 1,260. And we're comfortable with that because earnings have just been so phenomenal. For next year, our target is 1,325 to 1,400. So from current levels, including dividends, an expected return of about 10%. We're more concerned about Europe, and we think while it's very cheap, Europe typically is about, let's say, 24 to 25% cheap to US on average. Right now, it's more like 34, 35, actually 37%. So there's a nice gap, but we're just so concerned about the impact on the banks and policy that we think it's a little bit too early to add to European equities. If one has some, well, they're cheap, one holds on to them. But to actually aggressively go into Europe, we think it's early. And with emerging markets, they have cheapened a lot. They've underperformed, obviously, US equities, but we're not expecting a huge amount of upside other than just global equity beta. So if US equities do well, emerging markets will do okay, but we think at this point it's not really worth taking the risk there either. So we like core assets in the US, and specifically US equities, and actually we like US high yield a lot at 600, 700, 800 over treasuries. We think given an economic growth rate of 1.5% to 2%, it's a good environment with default rates staying, let's say, around 2, even a little bit higher. You're looking at pretty good returns for the next few years. So that's the general commentary. 5 minutes left. So I thought I'd open it to any questions you might have. Yes?
30 years ago, I worked with Sachs Co. We just cleaned out my office, and I found my business card 30 years ago. Most of the people who twice were born. Yeah, but,
I see a lot of white hair. I think there are a few people.
back of my business card, it was Japanese. English in the front, Japanese back, most dominant investment bank at that time had Japanese behind its cover to show the power of the Japanese in the capital markets. Will the back of our business cards next year or the year after be Chinese? Okay, meaning China will dominate everywhere, like the Japanese did in the 80s. And will China actually be the savior of Europe?
Did Jeff tell you to ask that question? Because I usually am on a roll on the topic of China.
Everything I need.
That's such a great question, because I think this great euphoria about emerging markets and China is so exaggerated. And we continuously tell our clients, while economic growth can be 8 to 9%, that doesn't mean it's a phenomenal place to invest. In fact, if you look at the history of the Asian countries, and again, I do think there are a lot of people out there who might have been here in the sort of mid to late 80s when Japan was going to rule the world. And everybody was learning Japanese, and we all would have Japanese analysts in our offices as interns so that they would give us some assets to manage. And I remember I was at Fidelity in those days, and it was a big deal to have the Japanese here, and then we would get some significant assets from their financial institutions or from their insurance companies. And people are making that similarities now with China, to your exact point. The number of books that were going on and on about how great Japan was, and now the similarity about China is just incredible. But as we look at the reality, all of these countries in Asia that have started from very low GDP per capita, cheap labor, and a cheap currency, have been able to achieve phenomenal growth rates. There is nothing unique about China other than the scale. So if you look at Korea, you look at Taiwan, you look at Singapore, you look at Japan, one can see that pattern. And what's interesting is as the GDP per capita goes up, the GDP growth rates start to slow down. So this idea that China is going to grow at these rates for the next 20, 30 years and maintain this trajectory is highly unlikely. For anybody actually who saw the Wall Street Journal today, there's a very interesting article talking about trying to understand what's going on with Sino-Forest. And I think it's titled Falling Out of Love with China. And what's amazing is that it shows that even with the investigation that the board of Sino-Forest has done, they look at all the data and all the facts, and they say the data that you actually give to the Chinese government doesn't match the data that you're giving to the shareholders. And they said, oh, well, that's partly because property rights are not as recognized the same ways, and we don't have the same deeds as you have in the US. Or they have said that, well, we have different taxation requirements, so we have to adjust the numbers. But it's just a good example and a little bit of a wake-up call for people that the accounting standards, the rule of law, the practices are so different. There's actually a great study talking about investments in the US and globally and looking at management. And US is ranked #1. And then they talk about looking at all these factors that make for good investment, and US is ranked #1. So when people like emerging markets, we think it's a good idea to have some exposure, but people need to be prudent. China has major, major problems. And I sort of think of China, to your point about Japan, as China is Japan on steroids. So it's much bigger, growing very fast. The scale is huge. So when you're talking about demand for commodities or when they have an interest in something, the impact is significant. But the risks are not insignificant whatsoever. And again, it's a country of 1.3 billion people. The poverty is pretty low. If you think of, at the end of the day, we have to recognize GDP per capita in the US is, again, depending on what number you're looking at, what day, $47,000, $48,000 per capita. China, based on actual current currency rates, is a little bit over 4,000. If you want to use purchasing power parity, it becomes a little bit higher. But it's a very poor country, and it's a long, long time before China is going to catch up with the U.S. And we wrote a very interesting piece at the beginning of this year, our Outlook, and we called it Stay the Course, and the cover was George Washington crossing the Delaware. And we said people are underestimating the resilience, the strength, and all the unique institutional qualities of the U.S. that no other major country in the world has. And we're seeing it. Europe doesn't have it as well. And at the end of the day, we think this idea that we all will have to have Chinese our business cards should all have Chinese in the back. Again, the trend will continue for a while, but I think one has to be pretty realistic. And China is not coming to the rescue of the Europeans. They made it very clear. They're not just going to give money to the Europeans, and they said it has to be renminbi denominated, you have to open your markets, you have to do all kinds of things, and we just don't think that that is going to happen, and we think the odds of any money coming from China to support Europe in its current construct is very low. Do we have any time for any more questions, Jeff, or I just got the zero signal here? One more question? Yes?
Sectors, different parts of the world. Where do you see leverage going over the future, and are we going to have more or less money in the world system as we go through the next few years?
So as we think about leverage, it's such a big question. So are hedge funds more leveraged? Are households more leveraged? Is the financial sector more leveraged? So clearly in the US, we have had some significant deleveraging. So when people look at, let's say, the deleveraging that occurred in Japan in the first 10 years of their financial and equity market crisis, and you compare it to the US has been much more responsive and reactive. Are they exactly where they'd like to be? Well, they certainly have shored up their capital a lot. Will there continue to be some slow deleveraging? Yes, that's why we're not seeing lending pick up as much as people would like, but you're beginning to see some small signs, right, of business lending and consumer lending picking up. Leverage at the household level in the US, which we think is very important, is slowly improving. So we had savings rate go up to just under 6%, and people were improving their balance sheet, and we look at that in terms of debt relative to income. So we're looking at overall debt as a stock and then the flow of their income, and looking at how they actually try to maintain a certain level, and obviously they're leveraging up too much, and now it's becoming coming down to closer to a trend level. And we saw the savings rate go down to 3% and retail sales and consumption improve. Our view is it's going to stay in the 3 to 5% range, which will be good for the economy, but it also means that they are deleveraging. And with the US consumer deleveraging, the impact on global growth is huge. At the end of the day, all they can say about whatever people want to say about China, China is primarily export driven. The IMF has done a fantastic study that between what's directly exports and all their business investment related to export, that's 45% of their economy. So obviously if Europe is in a recession, which is our base case, and the US has modest growth, it will affect China. So if the consumer continues to slowly delever with a savings rate about 3 to 5%, we think consumption will be strong enough that generally a global growth in the U.S. of, again, between 1.5% to 2% and Chinese growth around 8 to 9 is reasonable. The question of leverage in banks in Europe is obviously a big question. They never provide the kind of transparency that the U.S. banks have provided, and the issue with China is an even bigger question mark. So to be able to really answer the question on leverage in Chinese institutions, it's a little bit difficult because no one knows. What we do know is that 10 years ago, when they wanted to take their banks public, they had a bad bank set up and moved all the bad assets into an asset management group, and they just rolled over those assets. So if we do see a big deterioration in China from property lending and commercial lending, and also a lot of pressure on the shadow banking system in China, then our view is that the government will step in and fix that problem because they do have the wherewithal to do that. Again, that's not a game that's going to continue for 10 or 20 years, but they can right now. With $3+ trillion of reserves, they can certainly afford to manage dealing with their banks. The big question mark is in Europe, and that's really a sentiment question. And when will sentiment turn, and when will the ECB act aggressively? The key issue is with the European banks, they have put in place all the liquidity measures that the US put in place to be able to handle the financial crisis. So it's not going to be a liquidity issue for the banks. It's really going to be a balance sheet question, and obviously they have to recapitalize, and so that's going to dilute shareholders at some point in some of the banks. But we don't think it's going to be a major drag. We're not worried about inflation. So to your point about cash out there, printing press, we don't think inflation is a problem at all in the marketplace. So we're out of time. Thank you very much.